Welcome to the Sex, Money, and Real Estate Podcast, the show for real estate couples about how to close more deals in the bedroom. My name is Nancy Jamison.
And I'm Bill Jamison.
And each week we deep dive into juicy, intentional, sexy conversations, sharing with you what it takes to create balance in your intimate relationships and your real estate business. Thank you so much for being here.
Hey, baby.
Hey, baby.
What's happening?
Oh, you know, just another day in Atlanta here and podcasting and all the things beautiful. How are you doing today?
I am awesome. I'm even more awesome because our great friend is here, Faye Sykes.
Yes.
Oh, hello, hello.
Awesome. Well, who is Faye?
Faye is our financial guru, mastermind, extraordinary investor for us and our family.
Well, investor planner. Or wealth manager.
Wealth manager. There you go. How long have we known Faye for?
A decade.
We've
been working with Faye for probably a decade. Yeah, at this point, I would say, right?
Probably.
I mean, gosh.
Feels like no matter, even not, it feels like it, right?
Yeah, I know. It's wonderful. It's wonderful. Awesome.
So what we know about Faye is that she is a native of Wisconsin and moved to Georgia in 2003. She's also a graduate of Syracuse University and has been working in the financial industry for over 20 years, helping people navigate the complex world of investments. As a holistic planner, she reviews, and by the way, I love that, holistic planner. She reviews your entire financial junk drawer and helps you not only clean it up, but see the missing areas that you may need to address. Faye Sykes, Scarlet Oak Financial Services, our wealth manager.
Whoop, whoop.
Yep.
Whoop, whoop.
And just a quick editorial note. Faye's website is Scarlet Oaks FS.
Scarlet Oak, no S after Oaks.
Oh, got it. Sorry.
It's okay.
Scarlet Oak.
ScarletOakFS.com.
FS.com. Yes.
Perfect.
Yes. Well, and what's your email address, babe?
It's F Sykes, FSYKES at Scarlet Oak. And Scarlet has one T, ScarletOakFS.com.
Awesome.
Cool. We'll put all that in the show notes so you all are clear on this.
Beautiful. Beautiful. Well, as you know, everybody, we like to start off every episode with magic. And so we define magic as the ability to influence ourselves, others, and life in an empowering way. Because you can certainly influence life and others and yourselves in a disempowering way. We like to definitely focus and highlight the empowering ways. So what do you have to share today, love?
I'm going to share about our son Lucas today. He had been hearing some conversation around the healing of not only fasting, but dry fasting. And so he chose to dry fast for 34 hours. Mm-hmm. No water, no food, and just hung out and went through the experience. And I just, as a reminder, Luke is 12. And made this decision on his own, and we supported it. And it was really, really cool. He went through it very powerfully. He, he got a little emotional here and there as he was detoxing and just going through the experience. And he stuck with it and broke fast with just a few sips of water the next day. And then a couple hours later, a little bit of cereal and reintegrated.
Berries, yeah.
And I was totally inspired by him, for sure.
Yeah. So I asked him what his intention was, and he said his intention was to live a healthier lifestyle.
Yeah, and then I guess the following up magic to that is that he's gone vegetarian this week as well. So
yeah. So it's really inspiring. I appreciate the courage and the wherewithal to take on new things. So awesome. My magic is that it's actually on the topic of Faye, and we, as we've talked about before, we are debt free and we have a little bit of cash socked away. And in this experience of COVID and everything, we're blessed to have that 6-month savings fund, and so clearly there is a lot of volatility in the market, and so we actually just funded our investments for 2019 right before the whole COVID thing hit with our IRAs and opened up some Roth IRA and 401k accounts. And so then I said, you know what, we need to let's take advantage of this market. We haven't necessarily been in this beautiful position before. And so we literally said, okay, we have $10,000. So go to town, Faye. What do you want to do with it? And so through some definite, expertise and guidance and research and all different things, we came up with this plan. And, so the boys have some really cool stocks that they wanted to invest in. And then we invested, in the money or the funds that we wanted to invest in, or the stocks that we wanted to invest in. And it was just really a blessing. So I personally wanted to say thank you to you. I mean, we trusted you implicitly. And it's just really exciting to have this conversation here, because where we came from, 8 years ago, 9 years ago, 10 years ago is vastly different than where we are now. And it's really fun to have this conversation now.
Yeah, and you stuck with us, Faye. I mean, there was through the whole planning phase, and just, there was a point where there was really not a whole lot going on, but yet you just kept, you kept us on track and helped us put some money aside here and there, even though we weren't necessarily investing, and kept us focused on the bigger picture.
Yeah.
So deep appreciation and gratitude for that.
Yes, absolutely. Definitely integral in the maturation of our relationship with money. So we really appreciate that.
Oh, that's wonderful. You guys are welcome. Very excited about it.
Yes.
Awesome.
Faye, is there anything you'd like to share as far as magic, how you influenced self, others, or life?
Well, it's interesting, what you guys have brought up about sort of that process. I find, and I've worked with a lot of different people over the years. Obviously, I've been doing this for a while, and it always gets me so excited when I have somebody that had a bunch of debt or wasn't in a great situation, or their credit score wasn't good. And then all of a sudden, through some hard work, it wasn't, that part's not magic. You actually have to do the work and be thoughtful about it. But to see the smile and, I'll just share one quick story. I had a woman who probably 8, 10, 12 years ago, single mom, had actually a coaching business. And it was more of a grief life coach, and just wasn't really financially where she wanted to be. She had no emergency savings, this and that. We actually got her to start saving $40 a month. And most people would think like, what the heck is that going to do? Sure. But 8 months later, she needed new brakes, and she called me crying, but a happy cry, because she had the cash to pay for it versus having to go to a credit card.
Yeah.
Wow.
Yeah.
And, I've just got story after story, but being a holistic planner, to me, it really is the whole plan. And, until you've got the emergency savings, you haven't really earned the right. And, I don't know if that's the right word, but it's kind of like, until you have the basics like life insurance and emergency savings, you really shouldn't invest in the market, because that money is not flexible or, as easy to access as other stuff.
Yeah.
That's a
beautiful.
Great point. Awesome. Thank you for that.
Yeah.
Woo, that's awesome.
Beauty. All right. So we, let's see. We are talking about weathering the pandemic storm today and how that impacts your credit and your home, really. So
absolutely.
Yeah.
So,
what's top of mind for you, Faye?
Yeah. Well, it's interesting. So first of all, I want to talk about interest rates. I actually personally just refinanced my home last week. Nice. And I only bought my place back in June of 2019. But at the time I had, and just for full disclosure, I got a 4.125, and my own personal mortgage company came back to me and refinanced me down to 3.125, which is going to save me like a little over $180 a month.
Yeah,
that's amazing.
That's huge.
And, math wise, it's going to be like over $70,000 over the course of the mortgage.
Right.
Yeah.
And so, kind of one of my things that I'd like to share with people is, one is if you've got anything over a 4% interest rate on your house, I've still run into people with 6, 7, 8, 10. Yeah. Sometimes if people, you don't have, maybe when you purchased the house, you didn't have the best credit. Right now, interest rates are so low that there's some really good opportunity. At least check it out. I had checked with outside mortgage folks, and with the closing costs, it just wasn't going to be financially feasible. But working with my current mortgage lender, they actually covered all the closing costs.
Nice.
Huh.
That's
Great.
fantastic.
Great.
So, yeah.
So what would you do with the extra money, Faye? Would you actually, that you're not paying on your mortgage now, would you put it back into the market, or would you essentially keep your mortgage payment the same as you were making so you could maybe pay it off more quickly?
Well, Bill, that's an awesome question. So we look at it from three different perspectives.
Okay.
One is, do you have enough emergency savings?
Okay.
If you don't have enough emergency savings, I'd actually prefer not to have extra money go to a house until we get the emergency savings, because if you don't have enough emergency savings, what do most people have to go to in emergency?
Yeah, credit card. Yeah.
Credit card, which equals, and a lot of credit cards might be 14 or 28 or 32%.
Yep.
At a 20%. So for those of you that don't know or have heard, if anybody has heard of compounding interest or the rule of 72,
Yes.
very exciting stuff. We'll keep this short, but this is probably one of the most important things that I could ever share with anybody when it comes to finances. The rule of 72 is you take an interest rate and divide it by 72. So if you have a 10% interest rate divided into 7.2, either somebody else, if you owe money, they're going to double their money every 7.2 years. But if you have an investment that's making 10%, you double your money every 7.2 years.
Yes.
So at a 28% interest rate on a credit card, that credit card company is doubling their money every 2.3, 2.4 years.
Wow.
Yikes.
Yeah. Yikes is right. Yikes.
Woo.
Okay.
So that's, that's a lot. So one would be, if there's enough emergency savings, then we look at what other debts might be. So if there's, let's say, credit cards at a 28% interest rate, or little cards like a Home Depot or Lowe's or what have you, it's kind of nice to actually nip out those because, a house has definitely some, and you guys can speak more on this, what the average appreciation of a home is. But it would be best to get the, emergency savings, get off the debt. Then when you kind of have that secure, is to basically pay some extra. And if you pay one extra payment a year to your mortgage, so let's just say your mortgage is $1,200 a year,
right.
You pay $1,300 a month, you will pay on average your house off 8 to 12 years earlier than the 30 year.
That's fantastic.
Yeah. And then just to back up, for your emergency savings, what are you recommending? Like, what's the emergency part? I'm not talking about the 6-month savings plan.
Yeah.
Like, what's your emergency?
Well, I think at least having $1,000 is really helpful, because that can get through a lot of binds.
Yep.
But for W-2 employees, we typically look at 3 to 6 months of living expenses.
Okay.
This isn't what your paycheck is. So let's say somebody could have a paycheck of $5,000, but their living expenses are actually $2,500.
Okay.
We're using that $2,500 number.
Okay.
For self-employed people that have up and down income where it's not consistent. Yeah, exactly. That would be 6 to 12 months.
Okay. Of living expenses.
Of living expenses would be the ideal. But as you guys know, working with me for a long time, Rome wasn't built in a day.
Right.
Right.
Yeah.
It's a process.
Yeah.
So having go ahead.
Oh, I was just saying something is better than nothing. So.
Exactly.
Yeah.
So the 1,000 is good, but the end game is that 3 to 6 months or 6 to 12 months.
Got it.
Okay, cool.
Cool.
I appreciate the Avenger reference too. Endgame. Hashtag Endgame. Thank you.
You are welcome on that.
Awesome.
Well, and so just to kind of give people an idea on the refinance part. So if you've got a mortgage on, let's say, a $250,000 house at a 4% interest rate, that would be about $1,200 a month plus tax, insurance, maybe an HOA.
Sure.
And making an extra $200. I did a little calculation ahead of time, but doing a little extra $285 a month would shave 10 full years off that and save somebody over $60,000 worth of interest.
Yeah, that's definitely.
It's very doable. A $250, let's say somebody refinanced or had a 3% interest rate, instead of $1,200 a month, that'd be about $1,050 a month. And basically, kind of that $285, $295 a month extra would still shave off 10 years and would save about $43,000 of interest.
Oof.
Yep.
So little bits.
That's very important. It's a
Yeah,
lot.
little bits make a big difference. That's
Yeah.
really what I'm hearing you say.
And that's definitely the conversation that we're having as we're making our connecting phone calls with our peeps. Like it is, about the refinance conversation because, you can save a lot of money and it's not a whole lot of hassle to do.
Yeah, I actually was down visiting my sister in Florida,
Nice.
and a mobile notary came to her house, and I did my closing remotely.
That's fantastic.
There you go. Okay, cool.
On the beach with a cocktail in your hand.
Allegedly.
Allegedly. I would say.
Allegedly.
That's funny. That's funny.
Awesome. Okay. So we're hearing a lot of forbearance conversation. To forbear or not forbear.
Yeah, and that is because, the forbearance can be amazing or it could be very not amazing. And it really depends on your mortgage company.
Okay.
Some forbearance, and I've had some clients that have had this where they had a forbearance or they did not have payments for, let's say, 3 months, and it was tacked onto the end of the mortgage, those 3 months.
Yeah.
But other mortgage companies, after the 90 days or 3 months, it's a balloon payment.
Yeah.
So if you had, let's say, a $2,000 a month payment, all of a sudden you still might not be employed or might be in a financial bind, and all of a sudden you owe $6,000, then otherwise you're out of terms with your mortgage.
Right. And then they'll call the note. Yeah.
And then they'll call the note. And, what we don't want to see is 2008, 2009 with a lot of people short selling and foreclosing, which would be kind of our next sort of topic is on the credit scores and how those kind of things affect. But it's, you really need to get details from your lender to see how that's going to work.
Yeah, absolutely. Yeah. And get it in writing.
Absolutely,
Get
100%.
it in writing. Call them and have them literally mail you like the documents and the terms of the forbearance before you say yes to anything. I mean,
100%.
99% of the time you have to sign over that document anyway, but yet make sure that you really fine tooth comb that thing. Because that's happened to our friends of ours.
Yeah.
They went through the forbearance process and then it was a balloon payment.
Because
They originally talked about like loan modification, if you will, or like modifying it to where they would add it to the end of the loan. And then when they got the papers, it was like, nope, you got to pay the balloon payment all at once.
And they were like, well, if we had known it was going to work like this, we would have worked harder to make our payments along the way instead of to defer it.
Yeah, and not pay. Right, because
Right.
now they're playing catch up and they haven't gotten
Right,
the forbearance. So,
Oh, absolutely. And it just can put people in a bad bind when they at least, they couldn't plan for it and might have spent the money on other stuff.
right.
So, so it's like if you look at the forbearance and it's not an option and money's not coming in, not everybody's really had the ease of getting unemployment. Not everybody's gotten the PPP, which really isn't for personal expenses anyway. It's for business.
Yeah.
The next thing I really talk to clients about is selling the house, and if this continues on in a more economic dire way, the thing is that you might be later on, you might be competing against short sales and foreclosures.
Yeah.
Right, which is always an interesting time in real estate for sure. I mean, because now you're not just working with, as a real estate agent, you're not just working with regular, retail type of deals, but now you're trying to negotiate with banks, and that's always makes things a little bit more interesting.
Sure.
Repairs,
Yeah, the appraisal
process, all of it. It's very challenging. We've done that before.
Well, and also the price-wise for selling your house.
Yes.
Oh, yeah.
The competition where if you're just trying to get top dollar, we're shifting into more of a buyer's market than a seller's market that we've been in. How long were we in a seller's market for?
Yeah. I mean, since
2011,
I think we really came out of
11 or
it.
12,
it's been a long time. We're well overdue. Well overdue. So, that's one of my things I'm telling my clients again is if you have any thought of selling, you might want to consider it now because in another 6, 8, 12 months,
we don't know exactly what's going to happen around the COVID.
Yeah.
You might get top dollar now, but down the line, you might be in competition with other people you don't want to be in competition for.
Yes, that, I mean, and you know, there's no crystal ball, and you know, you never really know that you're at the top of the market until you're on the other side of the hill.
Until you're looking back up.
Right.
Going, oh, I missed it.
Yep.
Damn it.
Yep. We've had that experience.
We missed it the first time around back in 2007. We were like, ugh.
Well, I went through a divorce. So my ex-husband and I bought a house, and we ended up having to short sale because we didn't want to have the house anymore. And, you know, it was about $140,000 less than what we paid for.
Oh,
wow.
Short sale. Yeah. So, you know, and the thing is, I think it's super important to talk about credit.
Okay.
You know, when you think about credit, it affects your ability to buy a house. It affects the interest rates on that house, interest rates on credit cards. What people don't really think about a lot of times is that your credit score also affects your car insurance premiums,
Yes.
life insurance premiums.
Yeah.
Because it talks about how risky you are, which people don't really think about.
I've seen it, Faye. I've seen it with people have talked about their credit score as it relates to getting a cell phone service too, where like if you know they would pay different rates or different prices because of the risk they were because of their credit score.
Absolutely.
I mean, you have no idea how much your credit score can affect other things.
It really affects everything. But just, you know, for a short sale, that can knock immediately about 160 points off your credit score. So a 700 all of a sudden is 600 or 550 or 540.
Right.
That
You're
all
out.
this, you're out for quite a while. You're really looking at about 5 years. So again, I personally went through the short sale because of the divorce. After 5 years, you know, it was like that kind of rolled off my credit and I could buy a new house again.
Right. Got it.
Foreclosure can knock as much as 300 points off. So doing a short sale is much more advantageous for your credit score than a foreclosure when you're working with your bank.
Is a foreclosure going to stay on for 5 years or longer?
It's a little bit longer.
what I
You're
thought.
probably looking at more like 7 to 10.
Okay.
You know, and it's like if you need to go and buy a car, like I've had a woman who had a 28% interest rate on a new car.
Oh my.
28%. By the time I got her, she came to me, she only had 7 payments left.
Oh my gosh.
So it was a Lexus SUV. The car was like 50 or 60 grand and she had paid over $85,000 of interest.
That is crazy.
Oh my gosh.
Craziness.
Which comes to my other point. You can refinance your house. You can also refinance your
Yeah,
car.
Yeah.
You can you can go to like, I love creditcards.com. It's a credit card comparison kind of aggregate,
Cool.
but you can do like zero balance transfers and things like that. But there's ways to lower how much you're paying out. You sometimes just have to do a little investigation.
Got it. Cool.
So your credit score is basically comprised of a couple different things. 35% is payment history, like have you paid any bills late? Any accounts go to collections? Have you declared bankruptcy? You know, the more issues that you've had, the lower your score. 30% is outstanding debt. So, you know, I've run into one woman who she had 3 credit cards that had 0 balance and a third one that she put, quote, everything on, but it was like at 98%. Well, it was affecting her credit score because you need to leave more kind of a margin from that credit limit versus how much you have on the card.
Yeah.
So what?
So crazy.
Yes.
It's so crazy.
So
they wouldn't want to like calculate the limit of all your credit cards, but because she went so high on one credit card.
Yep.
Yeah.
It affects the credit.
Wow.
You know, the length of your credit history. I've got to, you know, sometimes remind people, let's say you got a credit card back in college or your 20s or 30s, whatever is your oldest credit card, you never want to shut down. Because if you shut it down and so let's say in 1990 you got a card and your next one was 2000, if you cut down that, you know, shut down that 1990, all of a sudden your credit score goes to the year 2000.
Right.
So it cuts out that 10 years of history.
Wow, I never knew that. Okay. Did you know that, Nance?
Well, yeah, I listen to Faye.
Oh. Okay. Sorry, I guess I was napping.
And there's two last ones. 10% is new credit. So if you're like at the store, well, not anybody's really at a store right now,
Sure.
but think of, in general,
Yeah, but
Home
you can do
Depot.
online shopping. Still
You can do
with,
online, and they're
Macy's or
like,
whatever. Yeah.
apply for the
The
Home
10%
Depot
off.
card and this card. Those affect your credit score. And it will dip it down temporarily. So that's just another thing. And last one is the types of credit in use. So
Okay.
10% in this. So they're looking for a healthy mix, some revolving,
Okay.
some installment accounts.
Okay.
So an installment account would be almost like that cell phone where you've
Okay.
got that $20 a month that you're paying, or let's say it's a dental bill that you're paying $50 a month.
I wish
your
my cell phone bill
mortgage-
was only $20 a month,
I
by the
know.
way. Just saying. Jeez.
I
Okay.
know.
So you were saying, I'm
But
sorry. I interrupted you.
revolving is more like credit card, and installments like mortgage and car.
Okay. Cool.
So they don't want to see it all in one or the other. They like to see a little mix of both.
Mm-hmm.
So anyway, there's all these different factors that can, kind of flip over and affect your score.
Yeah.
Specifically for your mortgage, they also look at a couple other things: child support payments, payday loans, public records. Have you had speeding tickets? Have you had, a battery, like any kind of criminal stuff?
So that's why they wouldn't give me a mortgage when I was like 17?
Yes,
Because
sir.
I had all the speeding tickets?
Yes, sir.
Okay, got it.
And rental payments is another one. If you kind of have a history of skipping out on your last month or two,
Oh, boy. Yeah.
that can get reported, which can affect the interest rate that you pay on a mortgage, which can be, if we kind of talk about the 4% versus the 3% on the 250, that's a couple, it's about $20,000 differential in interest.
It's so fascinating. It's like everything gets reported.
Yes.
You can have a history of skipping out on your last month's rent or whatever, or if you're like the person that says, "Oh, just keep my deposit," but that's not really what it's supposed to go for. And
Yep.
then you get reported for that. You do that a couple of times. Wow, that's fascinating.
It can really affect you. So credit scores can range from 300 to 850.
Okay.
Really, to get the best credits, for by getting a mortgage, you really want to be over like a 720 or 740. And what the mortgage people do is they do an aggregate of the top 3 reporting,
Right.
places. And, if you can be over that, you're going to get the best rates.
Okay.
So I think that's just really important.
Yeah. And that's obviously just been updated too recently, with everything, because there are folks that aren't even like in that 680 range that are no longer able to even get a mortgage any
Yeah.
longer. So it's, it's definitely important to keep that number up.
Well, and it's like for anybody, because there are some good deals that should be coming out at some point, checking on your credit score, obviously working with your Nancy and Bill, kind of your realtors.
Thank you.
And really getting pre-approval from a mortgage lender or broker ahead of time is really important. And then I also say for the first-time home buyers, there are multiple costs. And, although I'd bought a house before, it's like, oh, you have the appraisal, the down payment, the closing costs, the moving costs, the utilities set up. And the banks want to see 2 months of mortgages sitting cash in the account. So you can't go down to your last penny. So for people that are looking to buy, we can definitely help people understand how much you actually save and do a savings plan for them.
Yeah.
That's
Yeah.
awesome.
Yeah.
Yeah, and always, we recommend a lot to our buyers to, consult with their financial advisor ahead of time anyway, just to make sure that it makes sense. Because, you'll go get, we'll have clients who go and say, "Oh, hey, I'm qualified for $300,000," and they may qualify for $300,000, but that doesn't fit into their financial plan. And really, a $250,000 house would fit into their financial plan. And so if you don't have those conversations ahead of time, it may be hard to continue to work on that emergency fund or pay off some things that need to be paid off. And, your quote unquote house broke,
Which is, that's terrible. Well, and right now, if people's incomes have gone down, this might also be a great time to, I call it right sizing. Going from the super big house to maybe something a little bit more modest, and kind of getting all those things put together. And then there's some people that might be retiring and they might want to relocate somewhere else. But there's, it's just a good opportunity to really look at that credit score, look at what the cash value, what the market might bear, so that you have that opportunity to sell and get the maximum amount and not be sad at the end.
Yeah, absolutely.
I love that. I love that term, right sizing, because you could do that with so many things. We talked about this on another podcast, playing red light, green light, where it's like really expenses. Looking at your expenses and, especially all those subscription services and all that. But, right sizing could be your car, your house. I mean, it could be so many things that you have going on, you have payments going on. So totally makes sense.
Well, and my last little thing is the house should be a max of 20 to 25% of your overall income.
Okay.
But
your mortgage payment?
Mortgage payment or rent.
Okay.
Yeah. So, but the thing is, as you guys were just mentioning, if you have a lot of debt, if you have a huge car payment, you might need, if you want to really get into a house, let's say, you might need to right size some of these other things to be able to afford for your long-term goals.
Yeah. Totally makes sense. Yep. Awesome.
It's amazing.
That's a bunch of great information in a little amount of time.
Yeah. Absolutely.
Fantastic.
We always try, I try to keep it as concise and packed with information.
Yeah, we appreciate it. All right. Well, will you tell all of our folks your information again and how they can get in touch with you? What's the best way? I mean, social media.
Absolutely. Well, we're www.scarlet, SCARLET, scarletoakfs.com. You can reach me at F-Sykes, F-S-Y-K-E-S, at scarletoakfs.com. And my phone number is 404-354-1039. I do have a Scarlet Oak, and actually I do have a second company, Social Security Benefit Planners, but both of them have a Facebook page, Twitter page, Instagram, YouTube. I also do a lot of videos and things of that nature. So you can get a lot of information from following us on our different social media.
Yeah, awesome. Well, we appreciate you. The whole team is amazing. Like your whole office is amazing.
Oh, thank you. I love them. They're wonderful.
Yeah, that's great. Awesome. Thank you very much.
Thank you for having me.
Oh, yeah.
All right. All for now.
Yes.
Love goes out.
Thank you.
See you on the flip side.
Bye. Wow, what a show. Thank you so much for listening. If you're inspired, we ask that you share the podcast with one person and subscribe and follow our show. I'm Nancy Jamison.
And I'm Bill Jamison.
And remember, it's a great life.
Woo!
Quick note about the Sex, Money, and Real Estate podcast. We are not doctors or licensed therapists. We are a joyous, abundant, and mature couple passionately sharing our story of growth around sex, money, and real estate. Our thoughts, opinions, and beliefs are our own, so please consult your doctor, healthcare provider, or your broker regarding any questions or issues you have related to your physical or mental health or specific state laws regarding your real estate business.